Lesson 12, Macroeconomic Analysis. By the end of this lesson, students should be able to explain the concept of top-down analysis, analyze measures of economic performance, including leading, lagging, and coincidental indicators, interpret the government's intent when applying fiscal and monetary policy, recognize stages of the business and financial cycles, and discuss sector rotation strategy. As a top-down investor, you start by analyzing the economy first, then you focus on the individual sectors or industries. Three important questions that top-down analysts might ask are: what is the state of the domestic and/or global economy? What sector or industry is positioned to outperform in this economy? What companies are positioned to perform best in these sectors? The Market Vector website provides forecasts of numerous domestic and international statistics. This information can be accessed at the link provided on this chart. There is a wealth of economic data available to the top-down analysts wanting to answer the first question: what is the state of the domestic and/or global economy? Relevant data concerning the international economies include foreign business cycles, foreign currencies, performance of international stock markets, and levels of exports and imports. Important national data include GDP, employment, production and income, consumption, fixed capital investment, inventories, prices, money and credit, and stock market performance. The gross national product, GDP, measures the total market value of goods and services produced by a country within a specific time period. The four components that go into the GDP calculation are private consumption, private investment, government spending, and net exports. Each category of domestic economic data has several individual statistics that are periodically reported. As a top-down investor, you might focus on one or two in each category in assessing the economic environment. Important categories and specific statistics within those categories are provided for your review. Employment statistics include payroll jobs, unemployment rate, initial job claims, and help wanted signs. Production, GDP, industrial production, capacity utilization, durable good orders. Consumption, retail sales, personal disposable income, and consumer confidence. And fixed capital investment, housing starts, building permits, and construction spending. The Yahoo Finance site provides you with weekly economic data and a calendar of important statistics being released in the upcoming week. This information can be accessed at the link provided on this slide. Inventory statistics include change in inventories, business inventories, and manufacturing inventories. Measures of prices, costs, and profits include average hourly earnings, stock prices, and commodity prices. Money and credit include money supply, the yield curve, prime rate, and the trend in interest rates. Measures of how the financial markets are performing include performance of stock market indexes, the index of leading indicators, the index of coincidental indicators, and the index of lagging indicators. Another source of economic data is CNN Money. The following link will take you to CNN.com. Government policy is driven by the goals of price stability, full employment, and economic growth. To achieve these goals, Congress and the Federal Reserve have their respective fiscal and monetary tools. Fiscal policy tools. Congress and the President can employ income tax change, government spending, and deficit increases or decreases to affect the economy. Monetary policy tools. The Fed can affect economic activity through discount rate changes, open market operations, and bank reserve requirement changes. You can read more about monetary policy at the www.federalreserve.gov website. The direct link to this site is provided on the slide. Question: what might the Congress do to stimulate economic growth? Well, they can lower the tax rates and they could increase federal spending. What might the Fed do to stimulate economic growth? The Fed could lower the discount rate and lower the reserve requirements and increase the money supply through open market operations, i.e. buy government securities. The business cycle is a concept that describes recurring patterns of economic activity. The repetitive business growth decay or boom-bust cycle includes periods of recovery, expansion, peaking, contraction or recession, and troughs. Since 1945, there have been about 10 cycles, with expansions lasting approximately 4 years and recessions about 1 year on average. The financial cycle is a concept that describes recurring patterns within the financial market. This cycle tends to precede the business cycle by about 6 months. The first web link on this page will take you to a site that describes the business cycle. The second link contains statistical data on business cycles. The diagram on this page shows the financial cycle in blue and the business cycle in yellow. Notice how the financial cycle precedes the business cycle. That is because the market is a discounting mechanism. Market participants are looking into the future. That means the market predicts a business recovery before the actual business statistics start to improve. This diagram from Standard & Poor's and other interesting data can be found at the Fidelity website. The direct link to this page is provided on the slide. Sectors are larger pieces of the economy. They include several industries. You could divide the economy up into the cyclical sector, the growth sector, or the defensive sector. In the preceding chart, Standard & Poor's sectors were more specific. Examples of industries in each of those sectors follow. In the consumer and non-cyclical sector, you would find food, beverage, tobacco, etc. In the consumer cyclical sector, you would find autos, lodging, services, retail, etc. In the healthcare sector, drugs, medical delivery, biotechnology. In the financial sector, banking, insurance, brokerage. And in the technology sector, you would find industries such as computers, internet, telecom, and wireless. In the basic industry sector, mining, agricultural, and building materials, for example. In the capital goods sector, machinery, tools, electrical equipment, etc. In the transportation sector, trucking, shipping, air, and railroad. In the energy sector, refiners, exploration companies, service equipment companies. The utility sector, electric, gas, and water. And in the metal sector, precious metals, industrial metals, etc. Note, SIC and NAICS codes are U.S. government groupings assigned to industries. You can look up a company's code by accessing the reference book in your local library. The second question for the top-down analyst was, what sector or industry is positioned to outperform in this economy? Think back to the economic and stock market cycle diagram. It showed where certain sectors tended to outperform. That knowledge is the basis of a sector rotation strategy. Based on analysis and expectations for how a sector performs in a certain part of the business cycle, the active manager seeks to move assets from underperforming sectors to those expected to outperform. The asset purchase could be a sector exchange-traded fund, ETF, a sector index, a sector mutual fund, or individual assets, for example, stocks or bonds within that sector. The following site contains an interactive sector map of the market. It allows you to clearly see what sectors are moving up and down for different time periods and what stocks within that sector are doing. The URL to the smartmoney.com website is provided on this page. Question: how might an analyst identify where the economy is in terms of the business cycle? Composite indicators provide useful information. Leading indicators. These are measures that tend to rise in advance of an economic recovery. Coincidental indicators. These are measures that rise in tandem with the economy. And lagging indicators. These measures rise near the end or the peak of an economic cycle. The index of leading economic indicators. This index is composed of the following 10 indicators: the average weekly manufacturing hours, average weekly claims for unemployment insurance, new manufacturing orders for consumer goods, the S&P 500 stock prices, new orders for plant and equipment, building permits for private homes, vendor performance, i.e. deliveries being slower because of demand, index of consumer confidence, the yield curve spread, and real money supply growth rate. Again, these 10 indicators tend to rise in advance of an economic recovery, i.e. they are leading indicators. For information on business cycle indicators, click on the following web link. The coincidental index, i.e. those measures that rise in tandem with the economy, are composed of 4 indicators: the non-agricultural employment, industrial production, personal income, and manufacturing and trade sales. The lagging index is composed of the following 7 indicators. Again, these measures rise near the peak of the economic cycle. They are the change in consumer price index for services, the average prime rate, the average duration of non-agricultural unemployment, the change in labor costs per unit of output, the ratio of personal income to credit, the ratio of manufacturing and trade inventories to sales, and outstanding commercial and industrial loans. Another way to analyze industry prospects is to focus on the state of affairs within the industry itself. For example, you might consider the following: the industry life cycle. Is the industry in a startup phase or a consolidation phase? Is the industry now becoming mature, or has it reached the point where it will now decline? What is the competition in the industry like now? Is there a new threat of entry? Are there substitutes? Are companies within the space losing purchasing power? How is the industry positioned relative to emerging megatrends or paradigm shifts? For example, if you see a global need for energy, is the industry in a position to benefit from that global need? What about the aging of the world's populations, the emergence of nanotechnologies, and the internet, etc.? In this lesson, you learned about top-down analysis, measures of economic performance, including leading, lagging, and coincidental indicators, fiscal and monetary policy, the business and financial cycles, and sector rotation strategy.